So good morning, colleagues and friends. Thank you for joining us for this very important and exciting webinar, particularly as it's so close to the Christmas break. So we appreciate you all making time. I know it's a busy time of year. My name is Ali Reedhead. I lead our work on tax and extractives at the International Institute for Sustainable Development. And today we're launching the first guide on implementing a global minimum tax. So it's a guide for developing countries on how to understand and adapt to the global minimum tax. This is a product of joint work together with the International Senior Lawyers Project, a partnership that we're very proud of. And it's our hope that this guide will help developing countries navigate these complex reforms to make a decision that best suits their legal and economic context. And we look forward to your feedback. We're grateful for those of you that have provided feedback so far, and we're hoping to receive more comments today and in the months and weeks to come. I'm now going to invite my colleague, Enye Obebo from the International Senior Lawyers Project. So Enye is the Senior Legal Project Officer for ISLP. And once we've heard from Enye, then I'll turn it over to three of the authors of the guide, Steve Shea, Thomas Lassorde, and Kudzi Mataba, to present the guide. And then we have three very exciting panelists to join us to discuss the guide and, of course, the other issues surrounding the global minimum tax. And there'll be an opportunity for questions and discussion towards the end, but of course, feel free to use the chat and Q&A function as we go along. We'll do our best to respond to you. But if we don't get a chance, hopefully we'll pick your questions up at the end in that Q&A session. So without further ado, I hand over to my colleague Enye to provide some opening remarks. Enye.
Thank you very much, Ali, for that introduction and for setting the stage for today's presentation and discussion. As Ali says, I'm a Senior Legal Program Officer with the International Senior Lawyers Project, also known as ISLP. So allow me on behalf of ISLP and the IISD to extend our profound thanks to everyone joining us today for this virtual launch of the public consultation version of the guide. Again, just like Ali mentioned, we also want to thank everyone who has provided us with feedback and comments on the guide. It's been a very, very helpful process, I must say. So again, just not to take too much of our time, what we're trying to achieve with the guide is to provide an objective perspective on Pillar 2, and also to help provide a step-by-step guidance for analysts to develop country assessments addressed to policymakers to help developing country governments formulate an adequate response that still protects their taxing rights. In terms of the structure of the guide, the team will provide, of course, more details on this, but it's basically split into 4 parts, which will essentially describes what Pillar 2 is all about and how it works. It sets out a range of policy options that countries may consider in adopting GLOBE. It provides a step-by-step approach for countries to seeking to understand the likely impact of GLOBE on their tax base. And finally, it analyzes potential legal considerations impacting countries that seek to adopt domestic responses to GLOBE. Again, the team will provide you with more details on this. So again, we look forward to very active participation and to robust discussions today. Ali, I'll just hand back to you, able moderator and chair for the event. Thank you very much.
Thank you, Enye. Much appreciated. Now I would like to invite our colleagues, the co-authors of this guide. First, we have Stephen Shea. So Steve is a volunteer with the International Senior Lawyers Project. Thomas Lassorde, who's Senior Policy Advisor on Tax and Extractives at IISD, and Kudzi Mataba, who's also been working with us from IISD in the development of this guide. So over to the co-authors. Go ahead, Thomas, Steve, and Kudzi.
Thank you so much, Ali and yeah. So I'll kick us off with a brief introduction. So yeah, Kudzi, Steve, and I will give a brief overview of the guide, and then we move to the interesting discussion with the rest of the panelists. So first of all, this is probably superfluous, but just to make sure everyone is on the same page, to make sure they know what we're talking about today. So we're talking about the global minimum tax, also known as Pillar 2. And this came about after several years of negotiation within the closing framework on BEPS, piloted by the OECD or the G20, And last year, about October 2021, almost close to 140 countries agreed to the two-pillar solutions, Pillar 1 and Pillar 2. The idea is to address the tax changes from the digitalization of the economy. So Pillar 1 is the creation of a new taxing rights for market countries. So it sort of tries to address the challenge of the absence of a physical presence of large businesses in a digitalized economy. It's really the way it was agreed. It should target the biggest companies in the world, the ones that have turnover over 20 billion euros annually. And then Pillar 2, also known as the Global Anti-Base Erosion, or GLOBE, is the global minimum tax. So it seeks to create a system under which all multinational companies in scope of this pillar will be taxed at an effective tax rate of 15% in every country where they operate. The idea was to address the extremes of tax competition that had led to a so-called race to the bottom between countries competing to attract investment through their fiscal regime. And in terms of scope, we're talking about multinational companies with annual turnover above 750 million euros, globally annually. So a lot more companies in scope than in Pillar 1. We're talking about several thousands of the biggest companies in the world. Today, you'll hear us talk about Pillar 2, GLOBE, or the global minimum tax interchangeably. So for vocabulary, we're talking about the same thing under those three terms. So this is the point of departure of the guide. We weren't directly involved in the design of either of these pillars. We don't take a position on whether the solution is the right one, or whether the body that made the decisions on the solution was correctly managed, or the whole governance structure of the two-pillar solution. But we come from the basis that within the two pillars, it looks like Pillar 2 is the most likely to be implemented in the coming years, in particular because it only takes a few countries to start implementing it for every country in the world to be somehow impacted. And you'll see why in a minute when we talk about the rules. So we take this point of departure, and then that's how we design the guide of the idea is Pillar 2 is likely to be implemented. So it's important for every country to look at its potential impact domestically and think about adequate policy responses. So the guide is designed for policymakers, especially in developing countries and other interested constituencies who maybe haven't been closely involved in the negotiations around the global minimum tax, but want to understand what will be the impact in their country, where are the right responses that could be designed. So the guide goes through a brief explanation of the GLOBE rules, provide a framework to examine its potential applicability to the domestic fiscal regime, including tax incentives, think about potential responses that are adapted, and then also adds a bit of guidance on how to measure the impacts of the global minimum tax on in terms of tax revenue, and how to identify possible legal changes. So we'll go through each of these very briefly today, and we'll start with my colleague Steve talking about the first part of the guide. Thank you.
Okay, can we go to the first slide, or the next slide, I should say. So as Thomas mentioned, the way Pillar 2 works is in relation to what we will call constituent entities. I'm already going to get into some jargon, but we'll try and keep it simple, of these large multinational groups. So the next few slides, I'm just going to go very quickly at a high level through the rules that apply to these multinational entities if they have a member of the group in the country, in the source country, which is the country that we're focusing on. So again, We're focusing on lower income countries, and our built-in assumption is that most of the impact of Pillar 2 is going to be in relation to affiliates of groups in those countries. And so now we're going to say, well, how does this apply to the firms, to the groups as a whole that have an affiliate in the country that we're focusing on? The way the rules work is that they essentially try and ensure that every company in the group is paying, or every group of companies in a country in a group, but I'm going to talk as though each country has one affiliate in it to keep it simple. So let's assume the affiliate is in a country. The rules work to be sure that all of those constituent entities or affiliates in the country pay a minimum tax of at least 15%. And the way that's determined is to look at what are called covered taxes in the guide, but basically we can think of those for our purposes as the taxes that are imposed by that country in accordance with the local country's local tax rules. And we look at the relationship of those taxes on the entity in that country over the globe income that is of that entity in that country. So that's the ratio. And if a country tax, if the covered taxes are less than 15%, then other countries have a right to tax the income. And I'll come back on that question, but that's the key thought. So let's move to the next slide. The first right to tax actually goes to the ultimate parent entity. And when I say the first right to tax, let's start with country B in this picture, the low tax constituent entity, the low tax member of this group that we have in this picture. If let's say country B imposes a tax rate of 10%, but the minimum effective tax rate is 15%. So that would give country A in this slide the right to impose a top-up tax. And what we call a top-up tax is that difference between whatever the tax is that's imposed in the local country from the 15% if it's lower than 15%. So that's the key concept. The first right goes to the ultimate parent entity of the group. And I'm not going to get into details about if there's an intermediate parent entity and so on. So let's go next slide. Even though the country B may have, and I'm now going to use the example in the slide of 5%, let's say they have a 5% tax rate, but so the potential top-up tax is 10%. That top-up tax, that rate is only applied to the globe income after country B, globe income in country B, after you've taken out what's called a substance-based income exclusion, which is essentially a portion of the percentage of the tangible property that's used in country B and the payroll. And that percentage starts in different rates. It goes down eventually to 5% of each over a period of years. So next slide. Now, this is really a critical slide for purposes of the discussion in the guide. Pillar 2 says to a country B in our picture, to the local country, if your normal rules have end up with an effective tax rate below 15%, then you can apply or impose what's called a qualified domestic top-up tax to collect any difference that would otherwise be imposed on this entity in your country. And that means that if the low tax constituent entity were to be subject to a top-up tax after application of the substance-based income exclusion, then country B could impose a tax that would collect that top-up tax first and thereby preempt the tax by the ultimate parent entity, ultimate parent countries I'm sorry, the country of the ultimate parent entity. So this is a critical decision that we'll come back to later in the guide. Should a country adopt a QDMT? The other question is, should a country go beyond just a QDMT? That we'll come back to later. So next slide. So the last piece I really want to focus on is the undertaxed profits rule. And how does this rule work? And why is it there? It's there. It's included in this package of rules in case the country where the ultimate parent entity is located, in our example, country A, does not impose a income inclusion rule. It stays outside Pillar 2. And that is a realistic scenario at the moment. For example, if the United States were not to be viewed as a participant in the Pillar 2 regime, we're going to leave those details for later or for aside for the moment. But we can well have ultimate parent entities in countries in which Pillar 2 does not apply. So again, let's assume we have in country B a low tax constituent entity. And on the right, what the undertaxed profits rule is, it assigns the right to impose a top-up tax. It allocates it to other countries in the group. And in this case, it's country C. So that is the mechanism that encourages countries, once, to come back to something that was said earlier, that Thomas said, once a developed country or a series of countries start adopting Pillar 2, then you have the potential for a top-up tax if there's a group that has a constituent entity in your country. And even if the ultimate parent entity's country doesn't have Pillar 2, if another country in which there is an affiliate has one, then this undertaxed profits rule can come into play. So that is actually a second reason. It's not just the IIR, it's also the ability of countries to impose top-up tax under the undertaxed profits rule that creates really an important incentive for countries to look at these rules and decide how they're going to proceed. So just by way of summary and to move on, we have something called an effective tax rate, a minimum tax of 15%. If it's not collected in the picture in front of us in country B, or if the country B imposes a tax at a rate below 15%, then a top-up tax is potentially available. And if that would be, top-up tax would have some impact after the substance-based income inclusion or exclusion, then there's potential top-up tax to be taken by the ultimate parent entity's country, or if it does not apply Pillar 2 under the undertaxed profits rule, by another country, in this case, country C. So that's the basic framework, and the lessons are, once Pillar 2 starts to be adopted, countries have to pay attention, they have to make decisions, or they risk having top-up tax that's potentially available to them under a QDMT or alternative approach, go to other countries instead. Thank you, Thomas.
Thank you. Thank you very much, Steve. So that's a good transition to the second part of the guide, where we look at how to adapt domestic tax policies to account for the potential impact of Pillar 2. And the way we think about the different options that countries have is around first assessing what's the impact of Pillar 2. And Steve described very well just now. To make it to simplify it to the extreme, there's two possible impacts in terms of revenue of Pillar 2. Either there is no impact because there is no companies in scope of Pillar 2 in your jurisdiction, or there are some, but they are not taxed at an effective tax rate below 15%. In that case, no impact, not that much to consider immediately. But the other possibility is that there is a top-up tax arising in your jurisdiction because you have branches of multinational companies active present in your jurisdiction, and they're taxed at an effective tax rate below 15%. So as soon as you're in that category, then there is a top-up tax potential, and it's either going to be collected by foreign countries through income inclusion rule or under tax profits rule that Steve just described, or you have to increase domestic taxes at source in your country to prevent that top-up tax from arising in the first place. So that's the very basic calculation here. Either you take an option to increase taxation at source, or another country may collect that additional revenue. And so within that framework, we'll talk in the next part on how to assess that that impact economically. But that means that's how the guide frames the three options that countries have as a response. And maybe I started the opposite order. Option 3, which is to not necessarily take any immediate reaction to Pillar 2, and that's obviously the most adapted to countries in which we're in the situation where there is no immediate economic impact, revenue impact of Pillar 2, because they don't have low tax multinational companies active in their countries. So that might mean there is more space to focus on other priorities around domestic revenue mobilization. Now, the first two options, they're all about increasing domestic taxes to prevent low tax income from multinational companies, scope of the reform, to raise that effective tax rate at 15%. So in the first option, domestic minimum tax, the guide goes into a bit of nuance around the different options available to countries. There is obviously the qualified domestic minimum tax that Steve described. It's part of the global rules. It's been sanctioned by the inclusive framework on BEPS, and it's likely to be recognized by other countries in terms of credibility of taxes. But that's not the only option available to countries. There are a range of alternative generalized domestic minimum taxes that would still be considered covered taxes under the calculation of the effective tax rate Pillar 2, and so have the same effect of increasing domestic taxation at source and soaking up any potential top-up tax. So that's the guide goes into a bit of detail here on like the main considerations here, but basically there's a range of these type of generalized domestic minimum taxes, so from being really close to a qualified domestic minimum tax to somewhat further away from that original definition. And option 2 is about reviewing incentives, and it's not an alternative with the option to the option 1. It might be done in conjunction. But here, the idea of reviewing incentives is to address the causes of low effective tax rates, especially in countries that might have a high or relatively average nominal tax rate, but have a low effective tax rate, but because they have awarded a lot of tax incentives, especially tax holidays or different tax breaks, to multinational companies to invest in their jurisdiction. So here, this is one of the key targets of the global minimum tax, and it might be an opportunity for countries that need to review their incentives anyway, or have wanted to do it for a long time, to use this momentum to really go about and reform the way incentives are given to multinational companies. So in the guide, we go through general considerations on which type of tax incentives are more or less likely to lead to a low effective tax rate and should be reviewed as a matter of priority. We also have examples of countries in which we look at specific laws where these incentives are provided. And in that, those general considerations are very similar to other publications that have recently been came out from the same topic from the World Bank and the OECD, and one of our panelists today on the impact of Pillar 2 on tax incentives. I would just add that these are general considerations, but obviously to really account for the specific impact in each country of the tax incentives that are already been given to taxpayers or are in the laws and contracts, that requires a more detailed assessment specific to each situation and how these tax incentives play out on a specific company or specific project and with other parts of the domestic fiscal regime. So that requires a bit more granular analysis going forward. So there's a lot more in the guide, but I'll move for the sake of time, I'll move to the next part. So what the guide does as well is try to provide a bit of guidance on how to assess the likely impact of GloBE in your country. As I mentioned before, assessing the impact is probably the first step before deciding what type of response is best suited for a specific country. So the idea here is to what is required to assess how much top-up tax would be, how much top-up tax could be collected either domestically or abroad. So the guide does this in two ways. First, we pull out some main messages and findings from other publications that have come out on the impact of Pillar 2 based on publicly available data. And then we also provide a bit of guidance on the step-by-step approach that each government should be able to take. So in terms of those main messages, so I will highlight a couple. First, most of the analyses that have come out so far show that using aggregated country-by-country data at a global level, it seems like most of the top-up tax and the globe rules is likely to be generated in developed country economies and some low-tax developing countries and low-tax jurisdictions in general. And a good paper that does that is the paper, which is the table. This table is pulled out from the authors of the EU Tax Observatory, and what they did was do an abstract simulation where they simulate one scenario under which every country in the database implements an income inclusion rule, taxing minimum tax at the level of jurisdiction of residence countries, and another scenario in which every country taxes imposes a qualified domestic minimum tax at source. So that's the last column. And so when you see those two scenarios is that in both scenarios there's a majority of revenue that could be created by developed country, but in the second scenario, a larger proportion could be arising in developing countries. And I would add that this type of simulations is interesting to picture where the potential revenue will be coming from, but it also ignores important behavioral changes. Like if low tax jurisdictions start imposing a 15% effective tax rate, there are likely to be some change in how companies structure their operations away from those countries. And another important findings from publications here, I'm citing a paper from the OECD recently on the impact of Pillar 2 on tax incentives and the World Investment Report by UNCTAD that published last June. So what some of the studies show is that there's still a significant amount at stake for developing economies under Pillar 2, and that can be captured at source. And the reason is that even if there's less revenue on an aggregate basis, it's likely to be concentrated in some countries, because even if developing economies tend to have a higher effective tax rate as a whole in the aggregate, individual countries within that group might have more a lower effective tax rate. And within each country, you also have differences, and some companies might be taxed at a much lower level than others if they benefit from more generous tax incentives. So there will be pockets of revenue at stake under Pillar 2 in a lot of countries in the developing world as well. So it's important to make a thorough assessment in each country. So the guide actually does that, proposes an approach that each country can take to do its calculation, assess the impact at its level, using data available from the tax administrations, typically, either the country-by-country reports of taxpayers or other types of taxpayer data. I'm not going to detail it here, but I encourage you to look at the guide and send us feedback, and we're happy to work with governments on implementing that approach. So I'm now going to pass it over to my colleague Kuzai, who's going to talk to us about other important considerations in responses to Pillar 2.
Thank you, Thomas. Assuming that countries decide to enact domestic reforms in reaction or in response to globe rules, we envision that they may have to overcome certain legal barriers, particularly within their domestic and international domestic regime and their international agreements. We assess that the risk is overall low. However, it cannot be ignored. And in the following slide, we will look at the first risk, which is the risk of fiscal stabilization. So by fiscal stabilization, we refer to those clauses that either can be interpreted or are designed to keep a certain fiscal regime in place for duration of an investment, or to keep investment treaty conditions, frozen in time. So we find that these are a particular risk in developing economies more than developed economies, and we see them in wide use to present day. What we envision that countries should consider doing when they find themselves at risk of particularly arbitration arising from, I guess, what would be termed by an investor as an infringement of a stabilization clause is to firstly require that investors unilaterally acknowledge that the undertaxed profit rule will apply and the host country's top-up taxes would not result in damages. For example, if a host country was to decide to reform their tax incentive regime and effectively bring up the effective tax rate, that would not be seen as a damage-causing event. We would also, in, I guess, a broadest frame of mind, encourage countries to renegotiate stabilized fiscal terms in investment contracts because we view these sort of clauses to be highly constricting to the development of fiscal policy. In the next slide, we discuss the risk that emanates mainly from investment treaties. We firstly acknowledge that not only investment treaties will hold the sort of clauses that may be linked to investment treaty arbitration, but that these risks may also arise from WTO obligations. However, that falls outside the scope of this particular guide. The clauses we consider include expropriation, both direct and indirect. We also consider the interaction between national treatment and changes to domestic fiscal laws. We also consider most favored nation interactions with domestic law and fair and equitable treatment. Broadly, we view that any domestic responses that are closely aligned to the goals and objectives of GLOBE, which is to increase the effective tax rate of a host jurisdiction, will not be discriminatory in nature. Therefore, if a country were to enact any reforms in that spirit, so for example, as long as the reform measures can closely be aligned to the aims of GLOBE, their risk should be low. However, the risk should not be ignored. Where we do see potential for greater interaction with investment treaties is with the fair and equitable treatment clause. And their particular concern to us is the relationship between fair and equitable treatment and investors' legitimate expectations. By legitimate expectations, we mean that some contracts have been interpreted to mean that the terms of a host country's domestic regime should, or by all means, be kept at the same state at which it was at the time when the investment was made. And particularly with taxation claims, we've seen a growing number of successful claims based on the fair and equitable treatment clause. We find that this clause may be the most potentially problematic or the most potentially harmful to domestic responses, and this needs particular attention. What we do advise countries to do in delimiting their potential risk is to firstly ensure that any reforms in response to GLOBE are enacted in full accordance with the domestic legislative process and in a fair and equitable manner to all affected foreign investors. And by doing so, we imagine that, it is our calculation that any claims based particularly on the discriminatory clauses from investment treaties will not be successful. We also encourage countries to renegotiate effective investment treaties, and this could be a very targeted way of delimiting any potential risks in the absence of doing a complete overhaul of the investment treaty regime. And we also encourage countries to be particularly careful of the interaction between tax carve-out and their investment treaties. So we view that there are a lot of tax treaties or investment treaties will actually, or we view that although a lot of investment treaties will hold tax carve-outs, these in practice have not indemnified countries from successful arbitration claims, particularly, I think, in the last 20 years or so. We also refer countries and readers to the specialized guide by the IISD on fair and equitable treatment, which may, I guess, illuminate the risks more broadly than we do in this particular guide. Lastly, what we do in part 4 is to suggest some proactive steps that the OECD could take to mitigate potential legal risks posed by fiscal stabilization in particular. And here we firstly encourage the OECD to encourage companies to comply with any unilateral disclosure requirements imposed by countries. In the guide, one of the things we do propose for countries to do is to require that affected companies unilaterally disclose the conditions under which they would make they would make arbitral claims against reforms in response to GLOBE. We also envisage that countries, as I mentioned previously, should encourage investors to declare unilaterally that they will uphold any UTPR taxes. We also encourage companies to disclose to shareholders when they've been requested by a country to waive the stabilization obligation, and that lowers the company's ETR. Thirdly, we encourage courts and tribunals to adopt a holistic view of damages related to the implementation of GLOBE, because we view any domestic responses as inherently indiscriminatory. Lastly, we would encourage the OECD to also encourage countries to broadly review their bilateral investment treaties, particularly those that contain the sort of broad FET clauses that we view to be particularly harmful to domestic reform. And I think that brings us to the end of the presentation.
Thank you so much, Kudzi, and we look forward to your detailed feedback of everyone once you've had a chance to go through the complete guide. Adi, I'm going to pass it over to you. Thank you so much for your time.
Thanks very much, Steve, Thomas, and Kudzi for the excellent presentation, and hopefully it's whet people's appetite to pick up the guide and look at it in more detail. As Thomas said, there's plenty of time for people to review it and provide feedback. The deadline for comments is the end of January, so we encourage you to treat it as your Christmas reading or something like that. So now we're going to move to our panel discussion. And I'm delighted to have with us today three colleagues. Firstly, Suranjali Tandon. Suranjali is Assistant Professor at New Delhi, a New Delhi-based think tank, the National Institute of Public Finance and Policy. Welcome, Suranjali. Thank you very much for joining us. And next, I'm joined by Ruth Miner. Ruth is a Research and Teaching Associate at the Institute for Austrian and International Tax Law. Welcome, Ruth. And we will shortly, I think, be joined by Zach Boga. So Zach is an international tax partner at Ernst & Young based in New York, and he's also a volunteer with the International Senior Lawyers Project and one of the authors of this guide. So Zach has just touched down in Qatar for the World Cup finals. His flight was a bit delayed, but we've been told that he's landed and he'll be joining us in a moment to share his perspective. So first, I'd like to invite you, Suranjali, to share your thoughts on the guide, but more broadly, the global tax reforms that we're discussing today. First, I'd like you to touch briefly on the discussions that have been taking place this week at the level of the European Union. So people that are following these reforms closely will have seen announcements that the EU has adopted the global minimum tax. Then we saw some back and forth that perhaps that's not the case after all, but I'd love you to speak a bit about what's happening there. What are the implications for the Pillar 2 tax deal, and what are the implications for developing countries that might be watching this? And secondly, in your recent work, you cautioned developing countries from rushing headlong into implementing the global minimum tax and instead to weigh their overall economic objectives against the reform proposal. So in your view, what should countries consider as they make this calculation? Over to you, Suranjali.
Thank you, Ali. First of all, congratulations on the guide. I think it covers very many issues, some of which I'd like to talk about in the second part of my, So I think the first question that you raised about EU's back and forth on Pillar 2, I think it makes it quite clear that there are many countries that are now supporting this, and the Pillar 2 proposal may be a reality in the next coming weeks or months. As and when the consensus is reached. What we've seen is that UK has also put out a discussion draft, has put a timeline on when it will implement. And if EU goes through, you have two economies, which is Germany and France, which account for a large number of companies that are globally present and perhaps will be covered under Pillar 2. If you take the sum of UK, France, and Germany, about 10% of big companies, which is the Forbes 2000 list, would be covered. And that means that, all these companies which have presence in developing countries would then be, we would have the ability to claw back profits which are undertaxed in developing countries. And so therefore, this signals caution to developing countries that are giving tax incentives at the moment to think about what the economic impact will be for them. And that leads me to the other question that you raised, that, what is the caution or precaution that developing countries should take when adopting Pillar 2. I think one is that Pillar 2, even if countries abstain from it, by just a consensus approach, it will come to be implemented where an ultimate parent entity jurisdiction has adopted it. So I think there are a couple of things that need to be thought through from the perspective of developing countries. I think one is that any discussion on Pillar 2 seems to suggest that now competition should prevail in markets which are beyond tax, or on policy issues that are beyond tax. And what we've seen is that regulatory competition in no way is better than tax competition. And so countries, for example, that have weak institutions or may have inability to compete on regulation may find it even more difficult to attract investment and to push growth, where tax policy was available as a tool is now going to be replaced or may taper down to the extent that incentives cannot be offered. So I think that is one thing that countries should think about domestically, on how much is possible to replace tax with other regulatory measures. I think the other important point is the QDMTT, and there are 52 countries in the world that have a minimum tax which is domestically applicable, but these could be very simply designed in the form of turnover taxes. And so how does the globe compare with a domestic minimum tax, and whether going for a more complex system as is being proposed under globe, is it superior, or is it useful for administrations that are coping with already paucity of capacity? So I think that's another point. I think the guidebook brings out very interestingly the point of offshore indirect transfers and the subject to tax rule, which were of interest to source countries. And I think Pillar 2 doesn't talk enough about distribution of taxing rights. And I think that needs to again be understood and assessed by developing countries on how much would an STTR be beneficial on certain transactions and payments, and how would a minimum tax be useful for them. So I think all these considerations need to be taken into account. And lastly, I think what was mentioned was on the conflicts that may arise with other legal treaties. So for example, you have investment treaties where we've seen even large countries like India have struggled through cases on grounds of expropriation and FET. And so therefore, how do countries safeguard themselves from such risks? In addition, would domestic legal provisions be in conflict with, let's say, a dispute resolution system that would be necessary to implement GLOBE? So for example, if a tax certainty process that is being imagined under Pillar 1 is to be replicated under Pillar 2, and it mimics sort of arbitration, would it be compatible with domestic legal systems? And that needs to be seen, right? Because there would be countries where constitutions prohibit arbitration. So I think that's another concern that needs to be looked at. And of course, in terms of economic impact, countries must sit down to look at companies which are above 750 billion euros of revenue. They exist in their jurisdiction, are operating. What kind of incentives are they availing at the moment? And I think that is possible to do with the tax information available with authorities. So I would say that there are a couple of points that I've made that developing countries should consider before this becomes a global deal.
Thanks very much, Saranjali. You raised a lot of really interesting, valuable points there. I think in particular, the last point you made around dispute resolution and what are the plans with respect to Pillar 2. We know that with Pillar 1, there is some kind of, as you said, quasi-arbitration arrangement envisaged there, and whether that would also apply to Pillar 2. I think that's in and of itself has been very controversial for many developing countries that are concerned about ceding sovereignty over tax issues to an international tribunal or something of that nature. So I think the same concerns would apply here. So thanks for raising that point, and hopefully it's something we can come back to in the Q&A as well. Ruth, If I can ask you to share your thoughts next up. So you also recently published a paper, I think Thomas referenced it, along with other colleagues from the Institute for Austrian and International Tax Law, and you were looking at the impact of Pillar 2 on various types of tax incentives. So I'm interested to hear from you, based on your research, which ones in your view are most likely to be affected? And secondly, we hear from developing countries that tax incentives remain an important means of attracting investment, that some of the other regulatory changes that are required in terms of governance, rule of law, infrastructure, these sorts of things might be hard to achieve in the short term. And so tax incentives continue to be important in terms of attracting foreign direct investment. What are your views? Is there a place for tax incentives in a post-Pillar 2 world? And if so, what might these incentives look like? Over to you, Ruth.
Great. Thank you, Ali, for the wonderful questions, and thank you for just inviting us to give a bit of our results from our research. I think the key point, as we were speaking, and even as I was listening to the research, is that the globe impact on the effectiveness of the incentives is going to be felt by both non-inclusive framework members and inclusive framework members. So a country does not necessarily have to be part of the inclusive framework for it to have to start considering what the impact of the globe rules would be, because the implementation of the globe rules would impact the effectiveness of its incentives regimes. So a lot of countries, a lot of developing countries that we speak to mention that they have high statutory rates. But then when you look at the incentives that they have, it reduces the effective tax rate to below 15%. And especially where these incentives are in regards to profit-based incentives. And this, we prepared a sort of table that gives a rating of what we expect to see. So based on our review, we saw that the impact will vary depending on certain incentives, and incentives like the tax holidays and exemptions aimed at temporarily eliminating income taxes will be impacted highly by the implementation of the globe rules. Incentives like depreciation, loss carried forward, participation exemptions, and incentives on withholding tax will have little or no impact. For deductible qualified expenses, the specific exemptions for location, sector, and entity, IP box regime, and tax credits, the impact will vary depending on what the rate of the effective tax rate would be. So Thomas mentioned that the purpose would be that each developing country needs to review its incentive regimes, especially if they have in scope companies established within their jurisdictions, to see whether after calculation of the effective tax rate, it's below 15%. And so the second question you asked me was, what's the future of incentives? And I think what we expect to see is a shift towards more cost-based incentives. So like I mentioned, depreciation, loss carried forward, these are incentives that will have little or no impact. So we'll probably see a shift towards that. But also a lot of the out of scope companies can still benefit from some of the incentives that we've seen. And so I think the question is what countries would want to do, whether the incentives regimes would be an overhaul of the entire incentive regimes, or it would be an overhaul of incentive regimes offered to just in-scope companies. The important thing is that this Pillar 2 allows countries, or gives the opportunity for countries to review these regimes and ensure that the regimes are based on substance, the substance-based incentives, and they are achieving the objectives that they were intended to achieve. And regardless of, and as well as these cost-based incentives, we expect that there will be a shift. And I know you mentioned that it takes a bit longer to change the tax administrations, but this is still going to be a shift towards more effectiveness within countries. So a competition of public spending, quote unquote, looking at what kind of better infrastructure countries can have, ease of doing business, and then I'm more focused on having effectiveness of tax administrations and creating an environment of certainty for taxpayers. So these are long-term. The last 2 points are more long-term, but for now, what we probably would see was more cost-based incentives and probably retaining of incentives for out-of-scope companies.
Thanks very much, Ruth, for your intervention. We appreciate it. And now I'm going to invite Alison Christians to join us. So our colleague, Zach Pogger is, oh, he's here. There he is. He's in the airport, although he's logged in as Enye. So welcome, Zach. You made it. You're in the airport lounge. Welcome. Thank you for joining us. We're glad you made it to Qatar and that you could join us for this webinar. So I'll give the floor to Zach first, and then I'll come to you, Alison, as well. So as I mentioned, Zach is an international tax partner for Ernst & Young, based in New York, and also a volunteer with ISLP and one of the authors of the guide. And I've asked Zach today to share some reflections on, based on his experience working with Ernst & Young, what you envisage as some of the types of controversies that are likely to arise in response to Pillar 2. And secondly, how you think taxpayers and industry can best support developing countries that seek to implement Pillar 2. Over to you, Zach.
Thank you, Ali, and hi, everyone. Great presentation so far. I was listening from the plane, and now I'm in the airport, which is perfect. So really, when you think about Pillar 2, a lot of the success of Pillar 2 really depends on large companies and large firms being ready to implement these rules. And from a developing country perspective, there is, and the question pointing to controversy, really, I do like that, because there is, on the developing country side, on the one hand, the need to go ahead and maybe do something about the rules, but also really do something internally. And that's why the guide is extremely helpful. Doing something unilaterally internally to try to make sure that now that the 15% seem to be agreed as the new zero, that we are very able to keep the 15% within our borders, right? So controversy will be we're probably going into one of the highest controversy periods that we've ever seen in international tax, right? Because on the one hand, implementing these rules that are very complex, some of them are very uncertain, but also on the other hand, internally, the measures that the countries will be taking internally could be subject to a lot of controversy. So at private companies, the departments are getting ready to understand this rule, to try to abide by them. At the firms level, especially the law firms or the big accounting firms level, we are also getting ready to try to help not only the private sector, but really the governments as well, to try to implement this rule. So the success of Pillar 2 depends a lot on the readiness of the big firms and all of this private sector being ready to walk into the role. So the practice is, mostly preparing. I want to give a little bit of a view here from what I see from the private sector, the companies, but also internally at firms on how we are preparing. So I'm sure all of you have read all the various data points that are needed in order to comply with Pillar 2. So we are working with a lot of private sector companies to get ready for this data point and get ready to comply with these rules. And we are bulking up our experience, we are bulking up our expertise, we are bulking up our manpower to really be able to accompany all of these companies in applying these new rules. And we understand that Pillar 2 and the system that has been put in place with Pillar 2 is probably a lot of our future. So we are not, reserving anything in terms of building up capacity to be able to work effectively with companies and countries to make sure that this is implemented properly. And I'm gonna get just technical for a quick minute because the audience likely will benefit developing countries a lot. One of the provisions that has been very much in discussions as far as we have worked with a number of developing countries and small countries have been the provisions around permanent establishment, right? Because a lot of countries are thinking of themselves as being, small countries are thinking of themselves as being out of the Pillar 2 scope because they necessarily don't have these big companies present in their jurisdictions. But the way Pillar 2 has designed the permanent establishment concept, which is really totally different from what we have understood to now to be a permanent establishment, could really bring a lot of small countries into the tent, because a lot of small countries sometimes will host some kind of presence from these big companies, and that presence could end up rising to a level of permanent establishment as defined in the GLOBE rules. So permanent establishment is something I would pay specific attention to. And for those who have spent some time reading those provisions, the A, the B, the C, and the D permanent establishment, from a developing country's perspective, I will very, very much spend time on the B and the D permanent establishment to make sure that even if the company itself is not established as a subsidiary or big offices within my country, that I can still make sure I'm not, the company is not necessarily open to my tax jurisdiction through the concept of permanent establishment, specifically under B or under D. So that's something that has been coming up a lot for developing countries to pay attention to. Going back to your question, Ali, on controversy, and I think of this, and I think I previewed this just a minute ago in two ways. The first way the controversy might arise is really implementing the rules and a lot of the uncertainty that is embedded in the rules that we are now calling the GLOBE rules. And if I go back to my permanent establishment example in a minute, what would be a permanent establishment? The rules talk about a deemed place of business, for example. So if a developing country were to get aggressive, they can try to find a deemed place of business for many major companies within their jurisdiction. And if that deemed place of business exists, you can end up with a DPE where the developing countries get the entitlement to tax any income that is excluded from the parent company, right? Any income that is excluded for tax from the parent company will de facto fall within the DPE as long as you can show that it has a relationship with your jurisdiction, and that can give you a bite at the apple. And you can just see that coming with a lot of controversy, right? Like what is connected to your jurisdiction? What is it really meeting the definition of a DPE? And then other rules, right? The way you compute your taxable income, the way you layer in all these transfer pricing adjustments. So all of that is potentially subject to a lot of controversy coming up. And the application of the GLOBE rules itself might introduce us various levels of controversy. And we are preparing for that, right? To work with our companies, to work with our clients. And it is only appropriate, right, for developing countries or countries in general to start working up and preparing for that controversy environment that we're about to face. And then the other way controversy will arise is really on the unilateral measures that the countries might decide to take, right? We're talking in the guide, we talk about incentives, right? All these incentives, when you end them, right? Have you made a promise to an investor that you are now ending unilaterally? And if that is the case, are you subjected to controversy? We touched on earlier on stabilization clauses, right? Investors come in and they sign all these agreements with all these stabilization clauses. And if you want to end them unilaterally, because ultimately what they're doing is they're driving the effective tax rate for that specific taxpayer below the 15%, and the taxpayer may end up paying the top-up tax in the jurisdiction. So if you decide unilaterally to end that stabilization clause or that special treatment clause that you may have included in that jurisdiction, are you exposing yourself to controversy? In theory, yes. So this shows us how controversy might become really the driving word in the practice of international tax going forward. But when we drill down a little bit further on those concepts, right, such as special treatment, stabilization clauses, you ask yourself, what is the appetite, right, for the private sector and the companies to go after countries that may have unilaterally terminated these clauses, right? Because ultimately they will end up paying they may end up paying the top-up tax somewhere else. Do you really have an appetite to come in and put in a big fight to try to preserve that special treatment? The answer, one would think, is no, you don't have an appetite, but it's definitely not guaranteed, right? Because now that the companies will understand that maybe 15% is their new zero and they can do nothing about the 15%, they may realize that they have a choice on where to pay the 15%, right? And if they have that choice might influence other things, right? So they might put up a fight against country A to preserve that stabilization clause, even though they will end up paying the top-up tax in country B. And that top-up tax in country B might come in with other advantages that the country B will have accorded them. So as developing countries think about how to implement what measures to apply unilaterally, they may want to think about on the one hand, and we talk about it, if they decide on the repeal of the stabilization clauses and special treatment, they may want to think about how you establish a tax administration where it's actually good for the private sector to pay the 15% locally, because ultimately they may have a chance, right? What else are you doing to make sure that it makes sense for them to pay locally? And just from our perspective, we always, and usually you will find the private sector to be more open to paying tax where the presence is, because they want a more leverage, they want a more, but it's never a guarantee. If all they are getting is the presence and that B is offering them something else, they may end up making the choice to go to B to pay that tax. So that's something developing countries may want to think about, while the appetite is not there to go in and put a big controversy fight to keep the special treatment. It might be interesting to see that they will come in and try to make sure that whatever they're paying, the 15% that the country is preserving, and that they're making the choice quote unquote, to keep the 15% within your borders, that you're not actually disadvantaged by somebody else trying to attract the top-up tax by giving the taxpayer another additional layer. So that was a very long answer, Ali, but I think controversy is probably the word we're gonna hear a lot coming up. And I think we should be ready, and at the private firms, trust me, we are being very ready, and the companies are preparing really well. Thank you.
Thanks, Zach, for a very rich answer. And it sounds like you and potentially the rest of us have our work cut out for us for the next little while. So appreciate it. I'd now like to open the floor and take the opportunity to respond to some of the questions and comments that have come through in the chat. And I'm going to start with Alison Christian. So Alison is a professor of tax law at McGill University and one of the authors of the guide. Alison, we have a question from a colleague from Nigeria in the chat. Saying all thoughts are on developing countries who have subscribed to Pillar 2. I'd like to see what happens for countries who are yet considering, for example, Nigeria, on whether or not to sign up to Pillar 2. What would be the possible implications? So if you can share some thoughts on that and any other reflections you'd like to add as well.
Thanks so much. It's a pleasure to be with everyone. And I think actually Zach might have covered some of the answer to that. So I'm just going to repeat a little bit what he said. I think the key here for me is there's a pool of tax revenues that's produced by Globe. Whether you grab it or not is up to each country, and it can be grabbed if you like, whether you adopt Globe or not, under some assumptions. So the first assumption is that, although we have these notions about who can tax what and source and nexus and all this, there's also there's a shifting of those principles going on right now in Globe. So even if you don't sign up to Globe, there's absolutely nothing stopping a country from taxing at source under basic principles, and those principles being source, residence, etc., are broadening. So just in general, if you know that tax is going to be collected, then whatever tax incentive you've given to try to get capital in has already been weakened. Whether you join Pillar 2 or don't join Pillar 2, whatever you have that was using the tax system to attract capital is being taken away by some other country. And so now it's just a question. Are you happy with that outcome? Or do you want to try to take that tax, your source country, your residence country, or deemed PE, whatever it is, there's an opportunity to take that tax. It belongs to you in the same way that it belongs to any of the countries that are involved in the multinational chain. So from my perspective, the QDMT is not actually bound in any way by being a member of Globe. You can have a qualified domestic corporate, you can have a generalized domestic corporate alternative minimum tax. There's nothing stopping that. And it can track what's going on with Globe. You can have a domestic undertaxed profits rule. There's not actually any reason why you can't, other than some ideas that people have about, what problems there may be with that. All of this stuff gets worked out on the ground. And as I think Zach just perfectly elegantly explained, there's no way to get rid of all the uncertainty, either for the multinationals who are subject to all of these different rules, or for the administrators who have to implement them. There's no getting rid of the uncertainty, because we're in a period of transition. So I would submit that any domestic measures that look at what's happening with Globe and respond to it, even if not members of the inclusive framework or not taking on Pillar 2 as domestic, as long as what you're doing is tracking, you're in line with global standards, why wouldn't that be acceptable? It should be acceptable. And when I say acceptable, what I mean is it should be eligible for foreign tax creditability in other countries, because it's tracking the same base. And to the extent that somehow doesn't work out, I think the countries that don't accept it have to be called to task for that. If a country doesn't accept it and doesn't give a credit, and they're a member of the inclusive framework, what is the rationale for refusing that, if the entire rationale of Globe is to make sure that countries are taxing at some minimum rate? So that's just the framework here. I just have a hard time understanding how it is that an inclusive framework member, a member that has influenced the OECD's reports and guidance, would somehow then come back and push back against domestic measures that broadly track what's going on. So I can imagine that it would happen, but it shouldn't happen, and no one should rest on that if it does happen. So, but we're in transition, so we have to see what happens. Some things will be worked out through treaties. Some things will be worked out through negotiation at the inclusive framework. But that I don't think that there's any sense here that only members are involved in the transition that's going on in the global structure norms of international tax. That would be my first thing. And then I just wanted to add, in terms of the administration, that this is actually a real problem, right? That this is a complex regime, that some countries have perfectly adequate administrative systems. They're ready to handle it if they so choose. I think I might come from a country like that. And other countries are not. But the point of this whole regime, I think, is cooperative. So, I think that demands need to be made on the inclusive framework to make sure that if you build this complex global regime, you don't then just leave every country to their own devices, but you create an opportunity for countries to learn from each other and to share information. There's no reason why one country should be able to collect all the tax revenues because they have a better capacity going into something that they said was cooperative and inclusive. So those are my thoughts, and I'm happy to follow up if you need more. Thanks.
Thanks very much, Alison. Excellent. So I'm going to invite Thomas to briefly respond to Philip Daniels' question in the chat regarding extractive industry taxes. Thomas.
Thanks a lot, Ali, and this is an important question. And I would maybe first start by reminding everyone that extractive industries are included in Pillar 2. There's often a confusion because they are excluded from Pillar 1. There's a carve-out for extractive industries in Pillar 1, and that's in order to protect the right of producing countries to tax at source where the production takes place. So but under Pillar 2, the global minimum tax, extractive industries are very much covered. So it's important to consider the implication of the global minimum tax on the extractive sector. And Philip's question is important as well because there's a variety of ways that resource-rich countries collect revenue from production of oil, gas, and different types of minerals, and not just through income taxes. So there's still a bit of we still need to receive a bit more guidance from the inclusive framework and the OECD on the exact definition of covered taxes. But at this stage, it looks like to be, the simple rule is that any tax or any form of tax or assimilated payment linked to profits will be considered covered tax, and any type of payment that's purely connected to production will not be considered a covered tax. So think about mineral royalties that typically ad valorem based on the value of production or the quantity of production. These would not be considered covered taxes in all likelihood. But so profits taxes, resource rent taxes, windfall taxes, variable profits taxes, all of these would be considered covered taxes. And in all likelihood as well, the production sharing contracts that are based on where they allocate a share of the net profit of the operations to the host state would also be considered covered taxes. I think where we're going to see some, I don't know if disagreements is the word, but there would need to be a bit more details provided by, or like things need to be agreed between countries, is around payments that are at the border of these definitions. So for example, some forms of production sharing contracts have replaced the profit-based mechanism completely by a quantity of production. But if it's paid in lieu of a normal profit-based tax or income tax, that might still be considered a covered tax. But we have to see exactly where's the definition, where's the line is drawn in the sand. We actually the UN Tax Committee, there's a subcommittee on extractive industry, and they're looking at this particular issue. So you should also look at what comes out of that forum.
Brilliant. Thanks very much, Thomas. Suranjali, there's a question in the chat from Joseph, from Joe Guten Tag, I think it is. What steps have or will be taken to ensure that developing countries' tax policy staff and tax inspectors are trained with respect to these complicated issues? So you've got a unique position, being as close as you are to the Ministry of Finance in India, and I'm interested to hear your reflections on how India is preparing itself along the lines of what Zach mentioned with respect to the private sector and the advisory industry.
I think what we're seeing is that Pillar 2 is still evolving. There are so many related issues. I also imagine that this is going to be a dynamic process. Thresholds may be revised over the next couple of years. But what is being done at the moment, from my perspective in India, I see some level of preparedness already. It was almost as if Pillar 2 was happening. We have exclusions from bilateral investment treaties or taxation, which takes care of one element of the problem. Second is that India began phasing down or phasing out tax incentives, especially those to SEZ, over the last 4 or 5 years. And so therefore we see, the so to say headline tax incentives have tapered down. We're also seeing some rationalization of, tax incentives. And we also see a minimum tax which exists in India, so it's 15%. So I think all of the ingredients of the minimum tax are visible in India. I think what needs to be done further is a deeper examination of what kinds of tax incentives exist beyond, what we imagine as incentives, which is not just to SEZs or R&D. It could be in withholding rates, it could be financial income specifically, which are offered to sort of prop up capital markets. And I think information has become available to the country by country reporting, which are similar thresholds as Pillar 2, and those can be used further. As I imagine over the next couple of years, developing countries will have to set up units dedicated to Pillar 2 because it requires assessment, it requires information sharing as well as dispute resolution, which is different from a corporate tax system that is available to all other companies. So I would imagine that there should be more information sharing, as well as more capacity building on a unit dedicated to Pillar 2.
Thanks very much, Suranjali, for your comment, much appreciated. So now I'm going to invite Kudzai, if you'd like to respond to the question from our colleague Lamin in the chat regarding stabilisation provisions and or any of the other questions relating to the legal barriers to implementing Pillar 2. Kudzi? I'm not sure that Kudzai's there. Steve, do you want to jump in? So we've got a couple of questions around interaction between stabilisation provisions, investment treaties, and Pillar 2. There's a question from the colleagues from Connex about whether or not we envisage an increase in renegotiations of fiscal stabilisation provisions in the years to come in response to Pillar 2. And also a question from Michael Leonard around the issue of international arbitrations under bilateral investment treaties and whether or not the tribunals are likely to recognise the taxes paid elsewhere in the calculation of damages.
Yes,
Steve,
thank you. I was just writing my response to Michael, so let me start with him first. And thank you for the question. Now, my experience is limited, but I've been in a number of arbitrations. And I think Michael's observation that there could be a breach of the agreement, I agree with that. And so I think the point we make in the guide, and my experience is in the arbitrations I've been involved with, is that damages is a separate phase. And so even if you have a breach, the question is, what are the damages that the party who suffered from the breach has actually suffered? And there, I do think we want to be cautious. In general, you would say economically, if the same tax would have been paid to another country, as a matter of substance, there are no damages. Michael raises the point, I think implicitly, the question of, well, would the tribunal recognize that? And we discussed that relatively briefly in the guide. We think they should. I think as a matter of policy and substance, there's no question about that. I think as a technical matter, it does depend on the law that applies in that particular arbitration. I was an expert in a NAFTA arbitration where there was a holistic examination of what were the damages. So in some tribunals, that will be the case. In others, it's possible it wouldn't be. So I very much appreciate Michael's question and think it's one that we do discuss in the guide. Let me, I need to find the Connex question. To what extent? I think I now have it. To what extent are renegotiations of fiscal terms expected to increase? I think this blends into a broader issue that many on this call have spent a lot of time on, and that is there has been an evolution in stabilization clauses. And so I think we've kind of looked at the worst cases, which is what if you have a pretty flat freezing clause, as Kudzai discussed earlier. And so we already encourage countries to renegotiate flat, and not, first of all, not to adopt flat freezing clauses, and second, we would expect that renegotiations would increase. But if the prior answer on damages solves most of the problems, and if companies, as I think Zach suggests, may want to find resolutions that don't go to expensive arbitrations, how much you'll actually have to be renegotiated, I think remains to be seen. And Kudzai, I see you're on, so welcome your thoughts.
Thanks, Steve. I think I largely agree with you there. I think there's a lot of uncertainty, and probably as soon as the rules do get into play, we will see I guess we'll have a better picture, but right now a lot of it is rather speculative based on what we know about investors and how they deal with changes to tax provisions in domestic jurisdictions.
Thanks very much, Steve and Kudzai. And I think, as both Steve and Kudzai mentioned in the guide, we're firmly in favour of countries avoiding a wholesale renegotiation of stabilised fiscal terms and the investment agreement as a whole, because we think, you know, that can be a very costly and time-intensive process, and it can also open up opportunities potentially for taxpayers, investors to request new concessions to compensate for the global minimum tax and other issues that might arise in the use of discretion and so on. So I think, you know, we would discourage countries from going down that route if at all possible, and instead try and pursue this unilateral disclosure from the taxpayer to agree to pay the top-up tax that would otherwise be paid to the residence country instead in the source country. Excellent. So I'm now going to invite, there's a few more questions in here. Ruth, sure, I will pass that on. If any of our colleagues would like to respond to the question from Lou in the Q&A function, is there a dispute settlement mechanism envisioned for Pillar 2? Maybe Zach, you want to come back on this?
Sure, Ali. The question is whether there is a dispute resolution mechanism within the provisions of Pillar 2.
Exactly. So you were talking about all of the controversies that were likely to arise in response to Pillar 2. How do you anticipate that those controversies or disputes will be resolved? Is there provision for that within the Pillar 2 rules?
Yeah, Pillar 2 provides for alternative dispute resolution provisions, but also I would focus more on the unilateral measures that the countries may take, right? And going into those specific agreements per country and seeing how disputes should be addressed within those agreements. Because we are the guide, and I want to go back to the guide here. We're talking about what countries could do, if at all, right, to apply, understand and apply Pillar 2. And one of the things is really reviewing incentives that we talk about, right? Because like Alison just said again, and you now have potentially 15% on the table. And it doesn't sound very smart from a country perspective to let part of that 15% go and be taxed as a top-up tax or under tax payment rule somewhere else, right? And get there, maybe you will review your incentives, maybe you will review your individual agreements with some companies, maybe you will review your overall policy for tax incentive in order to encourage direct investment. So for each of those, we'll have to get back into the specific agreement and see how the dispute provisions were drafted. But in most cases, you will have an arbitration process or generally an alternative dispute resolution methodology, and we'll have to follow that. And I think Steve just mentioned that Steve just mentioned the anticipation is that the private sector may try to get some concessions locally in order to not be able to go through that really heavy process for controversy. So each agreement will dictate how those happens and potential outcomes to that.
Great, thanks very much, Zach. And last but not least, I'd like to give Suranjali and Ruth the opportunity to share any final reflections before we bring this webinar to a close. So Ruth, would you like to go first?
Yes, of course. I think the global minimum tax actually provides us an excellent opportunity to review our incentives, as everyone has mentioned here, something that we've been calling for years, and this is an excellent opportunity for countries to do this. And even if it's not expressly required that these incentives are eliminated, their effectiveness will definitely be impacted, and countries need to be aware of this. And despite high statutory corporate income taxes, these incentives can actually impact the effective tax rate. So this is an excellent opportunity, an excellent time to have this review done at the state level.
Thanks very much, Ruth. Suranjali.
Thanks, Ali, for the final opportunity to give my closing comments. I think there are two things that I want to raise. One is that, we have to look beyond just taxation. And I know that IISD works on climate transition and energy transition, and most economies are now looking to transition to low carbon pathways. And the UN estimates significant amount of investments to be diverted for this transition. We're seeing early signs of countries offering tax incentives to renewables. And if this transition is to go through smoothly, I still see the relevance of incentives. So it may be sensible to review, but again, the relevance of incentives would remain. And I think second is the importance of the composition of tax collections. So we've stressed on corporate taxes over the last a decade of the BEPS program. But there are indirect taxes which matter more in many countries. And so therefore pressures should not be exerted on incentive regimes within the indirect tax regime, which basically undermines this whole process of reform that we've been watching. Thank you.
Thanks very much, Suranjali. I think that's a really interesting note to end on. We heard from Ruth, and I think we agree very much with you, Ruth, that this is an exciting opportunity for countries in particular to kind of throw off the shackles of some of the more harmful tax incentives that they've been lumbered with for many years. So it's an important moment. But at the same time, as Suranjali says, it's not necessarily an easy decision. It's not a decision without trade-offs. That incentives do play a role, and I think many developing countries would agree with that as well, as that they can be an important means of attracting investment. But I think there's always been a place for well-designed, targeted incentives that are designed to motivate particular behaviors that are valuable and useful for the economy and society, right? So there's still a place for those types of incentives, and it's going to be interesting to see how countries navigate or kind of find their way through balancing both the need to try and reduce harmful tax competition and take advantage of the global minimum tax, but also keep a place for incentives in terms of motivating some of the behaviours that Suranjali spoke about as well. So thanks very much to our panellists for your very interesting and insightful interventions. We really appreciate you making the time. Thank you to all of the authors of the guide. And thank you most importantly to the participants that have joined us today for this webinar. We appreciate the interaction, the questions and comments in the chat. I think have been very thoughtful and provoking. So thank you for making the time, as I said, especially this close to the holiday season. We know that everyone's starting to wind down, and it's good to have you all here. Going forward, the guide is out for public consultation until the end of January, so please do send us your feedback to IISD or ISLP. The consultation period is until the 29th of January. We also plan to organise further consultation workshops with government officials, so there'll be an opportunity to talk about the guide in more detail and how we can make it more useful for the intended audience, so government officials in developing countries. And finally, we also hope to remain part of this process going forward, particularly in providing capacity building to governments that are looking to implement the global minimum tax or to explore the option to implement a response to the global minimum tax, and to also provide technical assistance to countries to look at the economic impact of the reform and also the legal framework and any potential barriers or issues that might arise. So we're looking forward to continuing to play a role as the global minimum tax inches forward together with our partner, the International Senior Lawyers Project. So thank you very much, everyone. And the last note, I think, was Go Argentina. Well, we'll see what the outcome is. Zach will be reporting live from Qatar, so stay tuned for that. But thank you, everyone. It's been a pleasure to have you with us today, and all the best for the rest of the year and the holiday season. Thank you very much.